Buckle up, because the Bank of England's upcoming decision on interest rates could directly impact your wallet. With the Chancellor's budget just around the corner, everyone's wondering, will they hold steady, or will we see a surprise cut? Experts widely anticipate that the Bank of England's policymakers will maintain the current interest rate at 4% following their meeting. This meeting is particularly significant as it's the last one before Chancellor Rachel Reeves unveils the highly anticipated budget. But here's where it gets controversial. Some analysts believe the latest inflation figures could actually make a case for a rate cut now. To recap, back in September, Bank of England Governor Andrew Bailey indicated that further rate cuts were on the horizon. And this is the part most people miss. He also emphasized that the pace of these cuts was highly uncertain. This uncertainty stems from the complex interplay of economic factors, making it a real guessing game for everyone involved. For those unfamiliar, the bank's base rate serves as a benchmark. It influences the cost of borrowing for both individuals and businesses, impacting everything from mortgage rates to business loans. It also affects the returns savers earn on their deposits. So, a change in the base rate has widespread consequences across the economy. The Monetary Policy Committee, MPC, the group responsible for setting interest rates, will announce its decision at 12 o'clock Greenwich Mean Time. As mentioned, most analysts are predicting a hold. You see, the bank had been consistently reducing the base rate by 0.25 percentage points every 3 months since August of last year. However, the expectation is that this pattern will be disrupted this time around. MPC members are meticulously examining the most recent economic data. This includes data on rising prices, inflation, employment figures, and wage growth. All these factors play a crucial role in their decision-making process. Specifically, the inflation rate in September was 3.8%. While still significantly above the bank's target of 2%, it was lower than what economists had predicted. A silver lining within the inflation data was that food and drink prices increased at their slowest pace in over a year, providing some relief to household budgets and potentially easing pressure on the bank to aggressively combat inflation. This slight easing of financial pressures has led some analysts, including those at major banking institutions like Barclays and Goldman Sachs, to suggest a potential rate cut to 3.75% this month. They anticipate a divided vote within the 9-member MPC, which adds another layer of intrigue to the decision. For the first time, the individual views of each MPC member will be published alongside the overall decision, offering unprecedented transparency into the debate. Danny Hewson, head of financial analysis at AJ Bell, puts the odds of a rate cut at only around 1 in 3. The odds are still firmly in favor of a hold, she states. Of course, MPC members are keenly aware of the potential impact of the upcoming budget, scheduled to be delivered by Chancellor Rachel Reeves on November 26th. The case for a rate cut in December could be strengthened if the budget includes substantial tax increases that don't contribute to further inflation. This is a delicate balancing act, requiring careful consideration of the budget's specific measures. The Chancellor herself, in a recent speech, stated that the measures included in the budget will be focused on getting inflation falling and creating the conditions for interest rate cuts. However, concrete details remain scarce until the budget is officially unveiled. Furthermore, additional economic data will be released before the bank's next meeting in December, which could potentially influence the thinking of MPC members. AJ Bell's Ms. Hewson even suggests that the Chancellor's surprise press conference might have been a subtle appeal for the Bank of England's assistance. By promising to push down on inflation, she might have been signaling that the bank didn't have to wait until after the budget to cut rates. Whether the bank follows through on this remains to be seen and is a finely balanced call. The bank's interest rates have a significant impact on borrowing costs, particularly for homeowners. Those with tracker mortgages are directly affected, while those with fixed-rate mortgages are indirectly influenced. In recent weeks, many lenders have been reducing interest rates on their new fixed-rate deals, driven by competition and anticipation of future rate cuts from the central bank. However, savers would likely experience a decrease in their returns if the bank decides to cut the benchmark rate. Rachel Springle from MoneyFacts highlights that many savers are already feeling demoralized due to falling returns and persistently high inflation, which erodes the purchasing power of their savings. So what do you think? Should the bank hold steady, or is a rate cut warranted? And how will the upcoming budget influence their decision? Share your thoughts and predictions in the comments below.